Rick Santelli standing by at the CNN in Chicago. Rick.
Yes, we're looking for our August retail sales numbers. Now, these are advanced. That means they're going to get modified and fine-tuned in a couple of weeks. The first number we see is up 0.1%. We're expecting a negative number. The reason? Because last month we were up a whopping 1%. That was the best going all the way back to the first quarter of 2021. Now, before I'm done, there may be some revisions, but that was a good number, and we haven't taken any back yet, at least in terms of the new advanced look for August. If you strip out autos, it remains up 0.1. Many were expecting it to be a little loftier than that, but do remember also in the rearview mirror, we have up 0.4 and up 0.5. So these have been rather solid reads. If we strip out autos and gas, it still remains good, up 0.2. One could argue we're expecting a little bit more in the rearview mirror once again, up 0.4. Prior to that, it was up 0.8, which was the best going all the way back to January of 23. Then there's what we call the core retail sales, or the control number that gets inputted in other economic statistics higher up the food chain. That remains a very solid up 0.3%. And prior to that, it was up 0.9% in June, and that was the best going all the way back to January 23. Now, there are revisions. Upward revisions. We see last month's get revised from 1% to up 1.1, and we see the core number move from last month's up 0.3 to up 0.4. So we could use the slowing labor market as a reason to ease. The Fed's looking for reasons to ease, but these numbers certainly don't build the case that the consumer is, on the side of the road with nothing left. We see that there's delinquencies. We listen to what Phil said, and interest rates, of course, even coming down a quarter point, even coming down a full point if they do over the next 9-12 months, isn't going to really take some of the pressure off those who need credit, because this two-speed economy still has many who don't need credit. And the Fed, no matter what they do with interest rates, it's very hard to target that group. We see that yields have moved up a little bit, but we're still basically at 15-month low closing yields in a 10-year, 2-year low closing yields going right back to September of 22 in a 2-year. And our last batch of guests really nailed it. The Democratic side of that discussion said, wow, we really have to fix the debt problem. They're currently in office, sir. Why don't they do something about it? Becky, back to you.